All right, welcome. Good afternoon, everyone. Welcome back to another stream. Happy Tuesday. Hope you're having a great week. So this is the Wealth Management Show. For anyone who's not familiar, this is a show where myself and various other guests who have expertise in areas either in wealth management or related to wealth management will, for an hour each stream, share our insight, our knowledge, and share with you a topic for the day each stream. So we'll typically cover when it's just myself and we don't have a special guest like today. We're going to cover the news very quickly, see if there's any big headlines. Spoiler alert, I've already looked. There's nothing too crazy, but we'll take a look, watch a few videos off Bloomberg's YouTube. Take a look at some Twitter feeds, that sort of thing. After we've done that, we're going to take a look at the markets. What's going on today, what's moving, what's up, what's down. Are there any sectors in particularly moving? Is there some sort of narrative that we could attach to what we're seeing? We'll cover all of that. A little bit of background on myself. I'm co-founder of an investments firm named Rushlight Investments, and my job at the firm is private wealth manager. What a private wealth manager does is takes that 30,000 foot view for clients, which usually has to do with their goals in terms of retirement, lifestyle, inheritance for their next generation below them or several generations below them. How is that going to happen? Are they prepared? Let's prepare them. All that sort of thing. And philanthropic goals as well. Anything that's a big goal is that 30,000 foot view of it is in my eyes at all time. And what I'll put together is a comprehensive plan in place to make sure that the portfolio, any attorneys that need to get involved in terms of asset protection, estate planning, a CPA that is specialized in taxes and tax planning. There's so many different components. So you need somebody to be synchronizing all of these things towards a specific goal. And that's really what my job is, just for a little bit of background. So welcome. Take advantage. This is an interactive stream. I'll be keeping an eye on any sort of questions you might have, any sort of comments, whatever you want to hear about. We're only live twice a week, so please take advantage. So we're going to go ahead and get started now. I see David's here. Good to see you, Sean Katz. Good to see you guys. I hope you're doing well. David, I'm up 100% on Planeteer. Do I buy more? David, I feel like you're messing with me maybe. So I'm not sure if to take that question seriously. But yeah, today's topic as well. So before we get into the news, before we get into the market watch, to give you a preview for the day, today's topic is going to be behavioral coaching. And what does that mean? Why is it valuable? If you happen to catch last stream, if you haven't, please go watch it when we're done. We covered a paper called Vanguard's Advisor Alpha. And what they did is they quantified and they answered the question, what areas does an advisor or a financial professional add value specifically? What things can they do that adds value? And not just that, they put a number to the value. So, A provides this value, B provides this other amount of value, C provides. So we went through those findings on stream. We analyzed what are all the different things that could be done, what are the specific value and amount that you could garner from having those benefits. And I think the key takeaway was it's not very obvious what are the most valuable things that a financial professional could do for you. A quick summary for those of you who didn't watch it, things like asset allocation, which in layman's terms is what to invest in and in what amounts. So what investments and how are they distributed? That's what people tend to think is the most important thing, but it actually wasn't the most important thing that they found. And there's a high variability in that specific service, right? Things like rebalancing or the managing of a portfolio. That's important, obviously, and there's a value, a benefit attached to that. But some of the other things, behavioral coaching included, which is what we're going to delve deeper into today for our topic, was the biggest value. And it came in at 1.5% per year of a value from behavioral coaching. And I wanted to cover that again because I feel that that's something that not many people are aware of. And I feel that if you're not aware of that, if you're not aware of the magnitude of the benefit, right, you don't know, even as a consumer, to make sure that you're receiving that. A lot of people are busy making sure, like I mentioned, asset allocation, or another one of the lower value items that people tend to be concerned with, sometimes more sophisticated investors, is the costs of funds that you might be invested in, right? If a fund is very expensive and there's an alternative that's cheaper, that's sort of free money. A lot of people understand this concept and they're very concerned about that. Absolutely, there's benefit to that. But is it one of the top most considerable benefits? It's actually not. So I think that some of the things people focus on don't have such a big value attributed to them. And some of the things people don't focus on and sometimes aren't even aware of have a much larger value attributed to them. So I wanted to cover some of these less known things and some of these not so understood, to shed light on them for you guys, not just for your own. If you're a DIY investor, you need to be taking care of these things for yourself in lieu of working with a professional. And if you are working with a professional, a lot of them don't come through on some of these other areas that were covered in the paper. So how are you going to make sure of that? You absolutely should. Good news is you're doing step one, which is, educating yourself, elevating your knowledge, coming on a stream like this one so you could be aware and acquainted with these sort of issues. So boom, we're already starting on the right path right now. So good on you for that. And Peter Thiel's, David, well, I mean, if you have a portfolio management question, maybe reach out to me after the stream and I'll get Gaston, because Gaston's not joining me today, the portfolio manager that frequents our stream, and he'll typically comment on more technical. Obviously, there's some follow-up questions. Just asking arbitrarily, I'm up 100% on a certain position. Should I sell? I mean, there's more. Obviously, a conversation needs to be had there. So if you're talking about that, you want to have that conversation, just reach out to me after the stream. Send me a message, either on Facebook or anybody on YouTube. You could always reach out to me as well. I think via message or a comment. I'll follow up with you, and yeah, we'll get the portfolio manager on for you. So great. I guess with that being said, anybody, actually, to start, I would love to ask you guys, what do you think is the benefit of an advisor? I know I kind of summarized some of them, but is it some of those things I mentioned, the asset allocation side, the costs of the funds and what funds are being implemented? Is it that sort of thing? Rebalancing, so the management, over time, buying and selling and keeping it in balance, rebalancing? What do you think it is? So I'd love to hear it. So let me know. With that being said, let's get into the news of the day. We're gonna run through the news and the market watch component of the stream very quickly today. So in roughly 15 minutes or so, around 12:30 Eastern, we'll be moving right on to the topic of the day, which I kind of briefly talked to you guys about right now, which is behavioral coaching. Why is it so valuable? But specifically, what is it? How can you know if you're receiving it? And if you are, what are the signs? If you're a DIY investor, what do you need to watch out for to try to make up for not receiving behavioral coaching from somebody else who's a professional? It's one of the toughest things to deal with in investing, the behavioral and the biases, the emotions of it all. So yeah, with that being said, let me switch screens over here so you guys could see the news, and then shout out again, Sean, David, Lourdes, anybody hanging out. It's great to see you guys. Hope you're having a great week. All right, we're switching over now to the news screen. And one thing that we've talked about quite a bit on previous streams, we recently transitioned to YouTube as well, on top of Facebook. And please, guys, click the link in the description, give us a subscribe. We really just started this last week. We're gonna start trying to promote it, grow this stream, and try to reach more people. I'd really appreciate any subscriptions, and check out some of our previous videos. We have a highlight with an asset protection attorney that we had on the show. It's a very awesome video for any of you that haven't seen it. And I'm going to start putting specifically the topic section of our streams onto a playlist, so that if you happen to not catch a stream, maybe the news isn't so relevant or the market watch isn't so relevant anymore if it's days past, but the topic for the day stays relevant. So, I wanted to keep that there for you guys in a separate area, easy to find. So yeah, definitely like, subscribe, share. If you have a friend who you think this is up their alley and they would like to ask questions live, please share it with them. I'd love to have them, love to answer questions. So look at this right here. Owner of apartment at 157, right? Which this is, I believe, in New York, in Manhattan. Yeah, right in front of overlooking Central Park. Purchased an apartment for $34 million in 2014. So now we're talking 6 years later, okay? He's in contract right now for $22 million, which is a $12 million loss. That's coming close to 50%. I think it's in the 30% range of a loss on that, which is pretty substantial. We've talked a lot about some of the news coming out has to do with what's happening with real estate. We took a chance to make the point before any of this was happening, where Manhattan real estate is very hot. There's a lot of people who are focused and their portfolios are highly concentrated in Manhattan real estate. Take the example of South Florida, where we live. Many people are heavily involved in real estate, and those who are really, really, really like real estate. And some of them, all of their properties are in a very specific geographic location, which is South Florida. And although it's a historically very hot market, etc., just like Manhattan, nobody saw something like a pandemic coming, right? But being geographically concentrated in real estate is very much like being very concentrated in a particular basket of stocks, let's say, within the entire stock market, right? There's real estate all over the world, all over the US. So instead of a diversified portfolio, some people are very focused in a specific area. It's all fine and dandy as long as nothing's going wrong and the market stays hot. But there's always these looming risks, things that we can't predict, things that nobody foresees, that when they come and those risks manifest, is when people then after the fact start to think, oh man, I guess I was not so diversified. So certain people who are extremely focused on Manhattan real estate are really suffering right now. And I would urge anyone that's highly focused in any area of their portfolio, or, in this town, in this area, South Florida, a lot of people are very focused in a geographic location as well. If something happens to this market and 50%, 60% of your net worth of your entire portfolio is that, it's really going to be a wild ride, and it's easy to not think about risks when everything is fine, but when they manifest, it's too late to deal with them. So again, just to echo diversification and the risk first approach that I talk about all the time, not being hyper focused on how much money you're going to make and what the potential return could be and how exciting that could be. Focus first on what the risks are. So if you're investing to build your net worth, what would a very large setback mean to your ultimate goal of that building that wealth? If it's, because you want to retire early or you want to be very wealthy. If you're very wealthy already, typically the name of the game is protecting, right? So it's all about the risks of to large setbacks in what you've already had. You want to protect it. So whatever the risks to your main goal are, they need to be taken care of first and foremost. And then from within those limitations, within those parameters, then we see how do we get the return that we want? How do we maximize the return after we've take into account what are all these risks that would be, fatal, let's say, to my goal. That's what I mean by the risk first approach. So whether it's, like I'm saying here, real estate, being geographically focused in a specific area, whether it's just stocks, bonds, your entire portfolio, whether it's hot tech stocks, which people love right now. Tech has been doing amazing, especially even post coronavirus recovery. Technology as a sector has been absolutely crushing. So buying stocks within tech, I'm sure did pretty good on average because the entire sector did great. But things shift over time, and we are actually seeing some shifts today. When we watch the market, you'll get a taste of that, of what I'm talking about there. So please take into account, the risks that are posed to your main goal, and then take it from there. Once you know you're not doing anything that's a major risk to those key goals that you have, whatever the reason you're investing, then you can deal with how we're going to get return the most efficient way possible, the safest way possible. So let's see here. There's a video here about the recovery that I wanted to show you if I could find it. One of the great things about that I really like about Bloomberg is that they do post a lot of videos. A lot of their headlines come out through the video, and it's one of my favorite ways to consume the news, right? That and headlines. So it had to do with that the recovery hasn't necessarily been even in all areas of the economy. That's something that we've talked about. And it was, here we go, how to fix an uneven economic recovery. Let's check this out, and then we'll comment on it.
One of the more striking features of the economic recovery to date has been its unevenness. The unevenness plays a key role in why the focus has shifted to fiscal policy. Signs of the uneven nature of how the pandemic hit the economy are everywhere. People stopped flying but kept on driving. With the work-from-home shift, formerly vibrant downtowns suffered much more than the suburbs. Some restaurants and bars will never reopen, while grocery stores and delivery services have done quite well. This unevenness is not easily handled by monetary policy. Central banks can take short-term interest rates to near zero, and they can purchase trillions of dollars of assets, but these are blunt instruments. Central banks are simply not well equipped to provide help for specific sectors because their tools are designed to lift the whole economy. Because fiscal policy has more room to be tailored to specific sector needs, and the pandemic's damage to the economy has been so uneven, the policy focus has shifted.
Yeah, I think this is a great point. One of the areas that we've seen it is when we review the markets, we've seen how, let's say, the technology sector has recovered very nicely. Something like the Russell 2000, which is an index, I don't know how many of you are familiar with. It's 2,000 of the smaller companies in the stock market. It has been a very different story. They only recovered to the point that they were at before the coronavirus pandemic hit, because there was a large drawdown in the market. As of recently is when they finally recovered. And many of you can attest to the fact that in your local areas, in your local, shopping centers, where you might have areas where there's, concentrations of restaurants, certain places have closed for good, as I've noticed, and it hasn't really been the same for everyone. Like, yes, obviously, maybe Google, everyone is using a bit more online services and that sort of thing. Amazon is obviously exploding, right? But and those are a large piece of our economy because they're so big. But there's so much more as we see the I'm not sure if I have it right here for you guys. The unemployment rate. Yeah, the unemployment rate that came out on Friday is still 6.7%. It came out a bit better than expected. I think they expected 6.8 or 6.9, and it came out at 6.7. But 6.7 is a high number for unemployment. You have to understand, we were, I believe, in the 3% ballpark before the coronavirus, pandemic hit us. So we're absolutely not back to where we were at all. Things are not functioning as they were, and I think that's one of the more concerning things as well. But I think the key point here that I would like to make to you guys that ties into the topic of the day is you need to really keep your eye on the emotional response to some of these things. Obviously, it's very concerning that we're seeing, the 6.7% unemployment, and that not all areas of the economy are recovering the same way, and that certain things that are being done to stimulate the economy haven't been working as expected. Those things are all concerning, but if it invokes an emotion in you that's strong enough to make you want to move and make you want to make changes to your asset allocation, how you're distributed through maybe too much stocks, you might feel like, man, I need to sell stocks because I'm scared, or something like that. You really need to take a look at how your risks are distributed, like I just mentioned. You need to be working with someone that has a risk-first approach and is using everything financial markets have to offer. A lot of people know about stocks and bonds. It's starting to become more common knowledge. Mutual funds, right? Stocks, bonds. You'll hear many people who've spent even a little bit of time dealing with investments, understanding these things. But there is so much more out there. Financial markets keep growing. They're like any other field. They keep evolving. They keep new things come out every day. New research papers with new developments are constantly impacting what's the best way to do things now with the new information that we have, just like anything, just like medicine, just like any other field. So you have to understand there's so much more besides that. There's commodities, there's currencies, there's alternatives, which is an entire world in and of its own. Technically under alternatives, things like art, we've talked about it on stream, whiskey, certain handbags, all these certain things can fall under that large umbrella of alternatives, which is just one other area to in addition to stocks, bonds. There's strategies that in and of themselves are diversifiers if all these things are properly designed. So when you use everything that financial markets have at your disposal and using it in a way where you're managing risks so that your goal stays certain, and the chances that something stands in the way or sets you back are minimized to the largest extent possible, you're not going to be so worried about what happens and in the economy as a result of second wave of coronavirus, the unemployment still being high, the fact, all these things we're talking about here, because they could all be very, very concerning. The headlines are almost designed in a way where they make you think I must do something about this, right? Look, they're highlighting a problem here on the horizon, but things need to be designed from the beginning in a way where these things are non-factors to you, and you understand that, and then you're immune to some of these, the psychological torture that comes with headlines, news, market fluctuations, etc. Anytime you've been emotionally tortured by news, stock market fluctuations, understand the root of the problem comes down to the risks at the top level not being properly managed. Okay, that at the end of the day, that is exactly the reason why. That is exactly what it comes down to. So yeah, keep that in mind. And we'll take a quick look now at the markets, actually, because it's coming up on 12:30, and we're going to move on to the topic any minute now. So let's take a look. Today, okay, we're slightly up on the S&P 500. This is a year-long chart on the S&P 500 we're looking at, as usual. It's usually the first chart that we look at. Here you can see the pandemic drop, the subsequent recovery, some of the volatility leading up to the election right here on the right-hand side of the graph, and a bit more of normalcy is, I guess, establishing itself now, since I guess things are still in process regarding the election. We'll see how this all turns out, but right here is this last little green bit is what's happened today. So if we look at some of the other indices here and some of the other areas of the market, gold and silver, some commodities, physical, precious metals happen to be up today. Bonds happen to be up today. International stocks just slightly. Here we see Internationals as an entire average distributed around the world are up a 0.14%. The NASDAQ, which is technology focused, is slightly down. S&P is up almost 0.25%. The Russell 2000, which what I was telling you is the smaller companies, is up almost a full percent. A big difference to some of the other indexes like the NASDAQ, which is technology focused, or the S&P 500, the 500 biggest companies. So as you can see, there's been a bit of a shift happening over the last few streams for those of you who have been watching, where, you know, the NASDAQ was tending to do better each day, and the Russell, for example, which is smaller companies, not so well. We've been seeing that pattern flip for several days, for several streams now. And it comes back to what I was saying a minute ago. If you were, let's say, participating in the technology area and you were doing very well, at a certain point, trends flip, you know, whether temporarily or not, they fluctuate. And if at a given point when there's a flip, you're overexposed or you're very, very highly concentrated, it could go very poorly for you. And if it leads you to make an emotional decision at that point, you're now starting to commit some of the cardinal sins in investing. Not only were you highly concentrated, when things got bad and emotional, you changed it right away. And these mistakes start stacking up on top of each other. And we talk a lot about, a wealth plan, your entire asset building and maintaining career, which is very, 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 very long. We tend to get over focused on what's right in front of us. So the last few days, the last few weeks, the current issues in the market. But you have to understand that's going to be a tiny piece of a very, very, very long journey. And mistakes over a very, very long journey really add up. Just like good decisions over a very, very long journey add up in another way, in a positive way. So please keep that in mind. Let's take a look at the heat map very quickly before we move on. Here we have the S&P 500. We could see maybe communication services is a sort of a slightly more red area, right? It's like a low light. Consumer discretionary and financials as well. Energy seems to be doing a bit better. Consumer staples a bit better. Healthcare is mixed. Industrials. This is one of the cool things about a heat map. You know, we could see the different areas at a glance all at once, maybe try to derive some patterns. If we're talking a narrative, this does fit the narrative where maybe things are taking a bit of a turn away from the massive shift towards things like communication services, information technology, consumer discretionary during the pandemic. And now as things are relaxing, some of the other areas that really got hammered, like the Russell 2000, are starting to, recover a bit. So, see here the NASDAQ, same, a little bit of the same. Let's just pull up the Russell just so you guys can check it out. Like I told you, this is 2,000 of the smaller companies. And since the boxes on a heat map, the size of them represent how large a company is relative to others. Here we see a tile of many different small companies, and mostly green, a bit of red, obviously within some of the same areas: information technology, consumer discretionary, that sort of thing. So yeah, let's move on. I think we did a quick market recap, but let's go on to the topic of the day, because I think that's really what I wanted to get to. That's really what I wanted to talk about with you guys, and I have some information to share. So just to reiterate, last stream we covered Vanguard's Advisor Alpha paper, and what that paper found and delved into is what are the benefits specifically of working with a financial professional. Not just that, how can we quantify that? What's the percentage value that we could put on they do X for me, they do Y for me, they do Z for me, and then what's the subsequent value to each of those functions? Okay, so we covered all of the areas that they uncovered and all of the values. I'm actually going to bring it up for you guys so you guys could remember, or anybody who wasn't here, so you understand where we were coming from with this. Okay, Here, I have it on my screen. I'm going to go ahead and switch over for you guys so you could see it as well. Here we go. So, and let me take off the schedule. It's blocking here. Perfect. Here we go. So what we're seeing here is they call them modules, but they're really, I guess you could call them strategies, right? Asset allocation, as I was telling you guys, they have it here at greater than 0 because it could fluctuate from person to person quite a bit. But you have to understand, in a very commoditized industry where most people, not all, most people are doing the same thing from one place to the next. So, oh, your stock, your bonds, and that's about it. The stocks, bond, mutual funds that I was explaining to you guys that most people understand. Not necessarily talking about beyond that, which deals with, like I was saying, currencies, commodities, alternatives, strategies that can be diversifiers in and of themselves, all these other things. It's very commoditized, and the difference and value added there is not just very volatile, it could be very, very minimal. And that's something that people highly focus on, right? The cost-effective implementation, so expense ratios, it says right here in parentheses. That is, what's the cost of the funds being utilized? Something that a lot of people, rightfully so, are worried about. And it's a good question to ask. Then they had rebalancing. And here they have the topic of the day, which is behavioral coaching. If you take a look on the right-hand side where the quantities and the values for each area are listed, basis points are, to translate for you, you add a decimal place right here in front of the 2 digits. So this is a 0.34%, a 0.25. So this is a 0.20, almost a quarter of a percent. This is 1.5%, 0.75. So 0.75%, etc. If you see the biggest value by far, by a considerable margin, is behavioral coaching. So that's exactly what I wanted to discuss with you guys here today. What is behavioral coaching? Exactly, right? So long story short, behavioral coaching is exactly what I'm doing half of the time or more on this stream. When we're reviewing the news, what am I always telling you guys? I'm telling you how to interpret this. Don't let these things modify your behavior. What are the components of this that are worth discussing, but they're typically not followed up with how you should adapt, how you should change, that you should take an action as a result. It's typically a spirit it's typically in the spirit, the way that we discuss things is lowering the emotional response to all of these things, to the headlines, to the new figures that come out, to any of these things. That is behavioral coaching in essence, okay? So how to respond to these things. What biases might be attacking us when we see the coronavirus pandemic, more deaths in a day than ever? Well, last time the coronavirus was really wreaking havoc on our people and in general, the economy and the stock market suffered dramatically. So a lot of times people are trying to, putting 2 and 2 together and thinking, oh my gosh, this means that the stock market again is just absolutely going to tank. Well, not necessarily. It's a lot more complicated than that. So letting yourself and that emotion come in and then drive your behavior is a mistake. How to deal with it and talking through it effectively and breaking it down into what are the facts, what do we know, what are just hunches. All of these things are exactly behavioral coaching, okay? Understand that is not something that everybody does. So although there's a certain value to this isn't necessarily a function that everybody does. I can tell you from firsthand experience, many times, especially with very large clients who are very valuable to financial professionals, when somebody's upset with something that's happened and they're in an emotional state and they might not like how an area of the portfolio has performed, there's very much an attitude of appeasement rather than behavioral coaching, unfortunately. And Behavioral coaching, one of the tough parts of this job deals with potentially losing a client, where if you know the right thing is to coach them through something, especially if the initial plan was done properly, like I was describing, with all the risks being addressed first and foremost, and then the long-term goal is fully in focus with what's being done. Behavioral coaching is really the response to, client discomfort or client dissatisfaction, assuming those things were done properly. Whereas I sadly, I've seen it before firsthand, where there's very much that attitude, I'm telling you, of appeasement, too much of a focus on absolutely not losing a client, especially if it's a valuable client under any circumstances. And although that theory really works in other industries and other services, when you are a fiduciary and you have a responsibility to your clients, not just legally, but personally, when you take your job seriously, and things like this, like the findings of Vanguard's Advisor Alpha, the answer to that stuff is clearly behavioral coaching, not simply the customer's always right sort of attitude that is absolutely valid in other areas. Okay? So if you're a do-it-yourself investor, understand that you're on your own and you're not dealing with a professional in this sort of coaching and a professional in these sorts of biases and managing them and everything that comes the emotional side, everything that comes with the emotional side of investing and managing a portfolio. When you do this professionally and you take your job seriously, you still empathize with where people are coming from. You still completely understand these sorts of emotional responses, but your response as a professional to that is not simply appeasement, it's behavioral coaching. And that's anybody who has any if you ask me, any self-respect for themselves and takes their job seriously and is knowledgeable. This is common knowledge within, sophisticated wealth management, sophisticated advisors. So if you're a DIYer, you're on your own there, and you really need to take this emotional side of investing very seriously. And if you're a consumer of investment advice, you need to make sure. That's why you need to be educating yourself on what's most important. What's the highest value component of what this person could do to me? I mean, not do to me, do for me. Once I know that, I need to make sure I'm getting this. I need to make sure I'm getting behavioral coaching. And we'll talk about maybe next stream, because I had some other things I wanted to discuss with you guys as well. The next stream is going to be on Thursday. But what's asset location and what's spending strategy? Because these have the potential to be very, very high impact areas as well. So you need to understand these things, whether you're a DIY investor or a consumer, so that you can make sure you're hitting all these points, because they add up to a very, very, very considerable amount. This entire list adds up to 3%. And this is an annual figure. So that means 3% per year, which is massive, which is absolutely massive. And especially when we're talking in the arena that I mostly deal with, high net worth investors, 3% sometimes is all that is needed in a given year to accomplish a specific lifestyle goal or income goal while protecting capital. So that goes to show you just the pivotal importance of these sorts of things. And I really can't stress enough. I've also seen heartbreaking stories where, especially before I was able to, when I was quite young, almost 10 years ago now, when I was still in college learning about investing and starting to get my feet wet and maybe getting my first internship and that sort of thing. I remember seeing clients that were shaken by massive market movements. And you could hear the fear and the concern. They're talking about, this is my nest egg. This is the market's performing so bad. I just looked at my last statement. I'm absolutely freaking out. And in the spirit of possibly appeasing a client, a change was made. And then when the recovery happened, that individual missed out, and that was a permanent setback to their goals, to their nest egg that they were so desperate to protect. So, that is a lack of and a fumble in the arena of behavioral coaching. So you have to understand, and especially in markets like in 2008, I know an individual who was heavily invested in stocks with professional help in 2008. This was shortly before I had gone into the industry myself. And they also were absolutely shocked by the 50% drawdown in the market. And they were almost fully exposed to stocks and nothing else, not very diversified. Another issue we talked about earlier. And when they saw the largest part of their net worth have in less than a year, you could imagine the absolute horror. You could imagine what that person was feeling. They made a shift near the bottom of this whole, the 2008 crisis. And that, again, was just a permanent, devastating setback. And just to keep it confidential, I won't give an amount, but it was a large amount of money. Understand, it was a high net worth investor, and it was almost a large portion of their assets. So I think that behavioral coaching is something that is so important. It sounds so simple, but the worst of our emotions and the most intense part of our emotions comes out during the most testing times, during the most volatile times. And that's specifically the moment where some of the worst mistakes are made. So you need that coaching, and you don't need appeasement, and you don't need things to be shifted around as a response to how you were feeling. You need somebody to deal with. It's actually quite funny if you look here. I brought it up, a list of cognitive biases. So these are all things that our minds are programmed to bias that lead to poor decision making. Just behold the vastness of this list. So you need somebody to help deal with this massive amount of bias and all these forces that might come up against you when things are bad or your emotions flare up and due to news, due to market movements, etc. How you deal with that, you need experts to do it. In my opinion, it's taken so many years of training, of studying specifically things that people might not think of what wealth manager studies. Like that Wikipedia page I just brought up with all these biases. So biases deal with psychology in to a large degree. That's the field in which that's studied. So some people might think, what's a wealth manager doing studying a ton of psychology all the time? And it has to do with the largest, most impactful finding of Vanguard's Advisor Alpha. Vanguard, thankfully, they're the ones who have done some great work in quantifying the value of it. So in that study, it's a very smart way to gauge what the effect of that is. Those who don't have coaching versus those who would have proper coaching, that they were able to put a number on it. But even before some of these studies have put an actual number on it, it's been known that this is one of the key values you have to understand. So, what's a wealth manager doing studying psychology? This is what he's doing studying psychology. It's 1.5% a year in behavioral coaching is the reason why, which is massive. So, that basically sums it up. If anybody has any questions for me on the topic, reach out after the stream, or you have my contact information. If you don't, I'll put it on the screen here on the end, on the closing. And I appreciate you guys for being here. Again, this is our a bi-weekly investment and wealth management stream. Like we did today, we'll cover the news, we'll cover the markets, take a look, and we'll cover a topic each day that sometimes will build on itself. Some of the recent topics has been goals, specifically why are goals so important? It seems like a silly topic, but it's one of the key things. And I made sure I covered it first. Go on to the YouTube page. Please give us a subscribe and look at our first live stream that was also on YouTube. We covered at the very end of that, what's up with goals? Why are they so important? Why do I talk about them all the time? And I went into detail. I think it's worth watching. The second one that we did last week had to do with just a general overview of the Advisor Alpha. And today I wanted to delve into the behavioral coaching specifically, which is just one component of that study, because since we did a general overview last time, I wanted to focus on what's that most valuable item and what does it mean? Because in the spirit of prioritizing, that's what you need to make sure is covered. That should be front of mind. That's what you need to make sure is covered first and foremost, properly. And you're already doing the right thing. Again, like how to deal with it, educating yourself, being on a stream like this one, learning about these issues. Reach out to me. I give free consultations just personally to those who are interested. If I have some free time, whenever we could do it, we'll get it done. I say all the time, people aren't hesitant to, when it deals with their health, go out and find a second opinion, especially if they're not sure about something or don't like what they hear. But when it comes to their wealth, sometimes people never get a second opinion, or they'll make a decision to deal with a certain professional, but as technology changes, as financial markets get more sophisticated and more things come out and the whole dynamic changes, they never get those repeating second opinions. And I think it's a massive mistake. Your wealth is sort of like an ongoing health thing. You know, it's not a specific thing. It's not a specific health issue that might have come up at once. It's a 50-year, 40-year, 30-year or longer plan. It's executed over, so long. You need to keep up with the new technology. You need to make sure that everything's being done properly. And as new findings come out, you're aware of them and they're being implemented. So good job for being here. That's like the first step in the process, understanding it, becoming familiar with it so you could defend yourself out there. There's a lot of sharks in our industry. You got to be careful. I'm here for you guys. Please, again, share this with anyone who you think would be interested. Hop on over to our YouTube. Give us a subscribe. It's a brand new page a brand new channel that we're trying to, we're going to start promoting it, and we're going to keep having guest speakers on like we recently had. We're going to keep bringing topics to you guys twice a week, elevating your knowledge, making you better consumers. So with that being said, I'm going to sign off for the day, and we'll see you guys again soon. Have a great week. And we'll be back on today's Tuesday. We'll be back on Thursday again at noon Eastern time. So big hug to all you out there, and have a great week.